a struggling house flipper, a new CEO, a pivot to AI, and a special dividend of tradable warrants going out to shareholders in 2 weeks. Oh, and 25% of the stock is sold short. This is about to get interesting. Here is the update to Opendoor Technologies, stock ticker OPEN. If you want the full breakdown on what Opendoor actually does, the iBuying model, how they make money, all that foundational stuff, go check out my first video on them. I covered all of it there. This one's purely an update on what just dropped. And trust me, you're going to want to hear this. So, Opendoor just reported Q3 earnings. And on the surface, it looked fine. Revenue beat expectations at $915 million. Market cheered for like 5 seconds, but then the CEO came out and said something that made everyone pause. We're refounding Opendoor as a software and AI company. Wait, what? This is a company that buys and sells houses. They've been doing that for years. And now they're pivoting to AI and software? That's not a tweak. That's a total identity shift. But here's the kicker. They didn't just announce a pivot. They also announced something I've never seen before, a special dividend distribution of tradable warrants to every single shareholder. And this thing is structured in a way that could either reward long-term believers or absolutely wreck short sellers if the stock runs. So let's break down what's actually happening here, because this is one of those moments where the story matters way more than the headline. All right, so the new CEO, Kasnajat Yan, basically walked into the earnings call and said, "We're not just flipping houses anymore. We're building AI tools to make this entire process smarter, faster, and more profitable." He called it Opendoor 2.0. And he's not messing around. They're launching over a dozen AI-driven products to speed up decision-making, improve pricing accuracy, and automate huge chunks of the buying and selling process. The goal? Get to adjusted net income break-even by the end of 2026. Now that's ambitious, because right now they're still losing money. They posted a GAAP EPS loss of -12 cents in Q3. They're guiding for a Q4 adjusted EBITDA loss in the high $40 million to mid-$50 million range. Revenue is expected to drop about 35% quarter over quarter because they're sitting on low inventory. But here's the thing. They're also saying acquisitions will rise at least 35% in Q4. So they're ramping up buying again, which means they believe they can turn inventory faster with these new AI tools. That's the bet. That's the whole thesis behind this pivot. And honestly, it makes sense. The old model was brutal. You're buying homes, holding them, reselling them. Every day you hold a house, you're paying carrying costs. If your pricing model is off by even a few percent, you lose money fast. So if AI can tighten up those decisions, better pricing, faster turnover, lower risk, the margins suddenly look way better. But that's not the wild part. The wild part is what they just announced for shareholders. And I mean, I've covered a lot of companies. I've seen buybacks, dividends, stock splits, but this is different. Opendoor is distributing tradable warrants to every shareholder on record as of November 18th, 2025. For every 30 shares you own, you get one Series K warrant, one Series A warrant, and one Series Z warrant. These things will trade on NASDAQ starting around November 21st under the tickers OPENW, OPENA, and OPENZ. So what's a warrant? Basically, it's like a call option. It gives you the right to buy shares at a set price before it expires. But unlike options, these don't decay as fast, and they're being handed out for free. No cost, no action required. They just show up in your brokerage account. Here's how they're structured. Series K has a strike price of $9. Series A has a strike price of $13. And Series Z has a strike price of $17. All of them expire on November 20th, 2026, unless they hit an early expiration trigger. And that trigger is huge. If the stock trades at or above 120% of the strike price for 20 out of any 30 trading days, that series expires early. So if the stock rips past $10.80 and holds it, the Series K warrants expire. If it hits $15.60 and holds it, Series A goes away, and so on. This is basically the company saying, we believe the stock's going up. Here's a way for you to profit from it. And if we're right, you won't even get the full year to exercise because the stock will blow past these levels and the warrants will expire early. It's a confidence play, but it's also a shareholder alignment play because if the stock runs, everyone wins. Shareholders make money on the stock and the warrants, and if warrants get exercised, Opendoor gets cash. cash they can use to fund this AI transformation without diluting shareholders through a traditional capital raise. So let's talk about what this could mean for the stock, because the setup here is kind of nuts. As of early November, Opendoor has about 736 million shares outstanding. The float, shares available for public trading, is around 709 million. And here's the crazy part. About 161 million shares are sold short. That's roughly 25% of the float. 1 in 4 shares trading is a short position. That's a massive short interest. And the days to cover, how long it would take shorts to close their positions based on average volume, is only 0.69 days. That's low, which means if something triggers a rally, shorts can cover fast. But that also means if buying pressure spikes, it could get violent. So you've got 25% short interest, a new CEO pitching a major transformation, warrants being handed out to incentivize longs, and a company that says they'll be profitable by 2026. That's a lot of fuel. Could the short squeeze? Maybe. It depends on execution. If Opendoor actually delivers on these AI tools and starts showing margin improvement, yeah, shorts could get squeezed, especially if the stock crosses those warrant strike prices and forces action. But here's the flip side. If they don't execute, if inventory doesn't move, if the AI pivot feels more like a buzzword than a real strategy, then this thing could just bleed. And those warrants, they'd expire worthless. So this is a high-risk, high-reward setup. And the warrants themselves are part of the narrative because they create urgency. If you believe in the turnaround, you hold the stock and the warrants. If you don't, you sell both. And if you're short, you're now betting against a company that just handed its shareholders free leverage on the upside. Let's talk about the dilution question for a second, because I know people are going to ask. Yes, if the warrants get exercised, new shares get issued. That dilutes existing shareholders. But here's the thing. Dilution only happens if the stock is already up. If Series K warrants get exercised, the stock's above $9. If Series Z gets exercised, it's above $17. At that point, you've already made money. The dilution is the price you pay for the rally. And more importantly, exercising warrants brings cash into the company. If all the warrants got exercised, that's hundreds of millions of dollars. Money Opendoor can use to scale this AI build-out without taking on debt or doing a secondary offering that tanks the stock. So yeah, dilution's real, but it's not the kind of dilution that kills you. It's the kind that comes with a win. All right, so where does this leave us? Opendoor's making a massive bet. They're pivoting from a house flipping model to an AI-driven software platform. They're handing out warrants to align shareholders with that vision. They're guiding toward profitability by 2026, and they're doing it with 25% of the float sold short. If they pull this off, this could be one of those turnaround stories people talk about for years. The underdog that everyone wrote off, the stock that was shorted into the ground, and then it flips the script. But if they don't, if the AI tools don't move the needle, if inventory stays stuck, if the market doesn't buy the narrative, then this is just another cash-burning house flipper with a buzzword strategy. So I'm watching this closely. I'm not telling you to buy it. I'm not telling you to short it. I'm just saying this is one of the most interesting setups I've seen in a while because the stakes are clear, the timeline is clear, and the reward structure with these warrants is totally transparent. If you're already in, you're about to get free warrants. If you're thinking about getting in before November 18th to qualify, just make sure you understand the risk. This isn't a safe play. This is a binary bet on execution. And hey, I hope this video helps you on your quest for profits. Catch you on the next one.